Welcome back to Sunrise Stock Research, where we help ordinary investors master the art of stock research. I'm Brian Matuzak, and today I'm going to talk about one of the most important yet underappreciated aspects of investing, stock idea generation. The reason this is so important is that your time and money are valuable. So you want to spend your time on ideas that have the greatest probability of success. We're going to talk about 14 methods that I've used to generate high quality stock ideas. First, quantitative models and screening. I start here because this is the most widely used method that big money managers use to generate high quality stock ideas. A typical model looks something like this. You'll see that it has four major factor groups. Growth, which is things like earnings growth, revenue growth. Value, things like price to earnings, price to sales, price to cash flow. Momentum, a lot of times that refers to stock price momentum, but also can refer to earnings revisions and earnings growth momentum. And the fourth bucket would be quality, and that would be things like balance sheet strength or other factors that would denote predictability and sustainability. And managers may score each bucket differently and add up to a whole score. And that score would then be ranked from best to worst. Many times you'll see managers will also sort that by sector. But in this case, I haven't done that. I'll have a whole section dedicated and other videos dedicated toward modeling. But this is kind of the short version of that. Here's some tips for modeling. First, focus on relevant metrics to you. If you find that you tend to be a growth investor, you'll have more of a growth-oriented approach and have more growth factors. A value-oriented manager, you'll have more value-oriented factors. But you can combine these signals in any way you want, such as growth and quality for more of a conservative growth strategy, value and momentum for more of a valmentum strategy, or any combination of different factors in which you want to combine. So the idea here is to make money and not lose money and generate the best high quality ideas that you can find. But keep it simple. You don't need a model that has hundreds of factors when a dozen factors might do the job. Another piece of advice is track the results of your model. Whatever the output of the model is, keep track of it. So go back next quarter, next year, next 2 or 3 years, and really analyze and backtrack those results so that you know whether that model is actually producing the type of results, the type of ideas that make money. And if it's not, you can tweak your model to find a better approach. So the next method we'll talk about is personal experiences. And this method is very simple, yet very elegant. So pay attention to the products that you or the people around you use and love. And when you think about it, companies with strong products and services often have strong customer loyalty, strong brand awareness, repeat sales, and pricing power. All very good things for a company to have. So some advice for this is really look for patterns and pay attention to the people around you. Talk to different people from different backgrounds. And, for instance, teenagers can tell me a lot more about fashion than I would ever have any insight to. But pay attention to what the repeat type trends are and the patterns in those conversations that you have. The second, validate with data. Make sure that the data behind that validates the personal anecdotes. You'll also find that this will target certain consumer-facing industries, consumer discretionary, staples, travel, and some technology companies. But be mindful of your personal biases or the biases of the people that are around you, as they may not represent the overall marketplace. Next, insider and activist activity. Now, this can be a very powerful signal of bullish trends inside a company. This is a website that I go to find insider buys for a company. And this can really tell you what insiders are doing. Some tips for here. First, focus on large transactions. Now, that's all relevant to the size of a person's personal holdings, but large transactions that would be large relative to a person's individual wealth. Second, track those patterns. If you notice that there's a cluster of buying, then that could be a very good signal. Third, understand insider roles. I like to pay particular attention to CEOs and CFO buys, as those mean a lot more than other insiders. My personal experience is that directors, on the board of directors, usually don't know a lot more than the analyst or other people who are following the company. They basically get their information from management, and they'll buy into whatever management says. Also, combine that with fundamentals, and that's true with any stock that we're looking at. Make sure that the insider buying is really supported by strong fundamentals at the company. And lastly, put insider sells into context. Insiders, they're always selling because they're always getting more shares, and they tend to have a large portion of their wealth tied up into a company. So they may want to diversify, they may have other needs for cash. So put that into context. So next we have cherry picking mutual fund holdings. And this is actually a pretty decent method to find new ideas, because those ideas generally get pretty well vetted by the mutual fund managers. But here's some tips. First, start with quality mutual funds. And by quality, I mean low turnover, strong performing, and generally low risk strategies. Stay away from high turnover type strategies, as one, those stocks that you may be looking at may already have been sold, so that information gets stale very quickly. That would also show a lack of vetting and a lack of conviction by the manager. So make sure that those funds have a low turnover approach. Second, look for new positions. You can compare that across funds, those positions. And finally, avoid buying on blind faith alone. Just because a manager owns it in a portfolio doesn't mean they're right. So here would be a typical report you can find in Morningstar for free. And it would show you, the holdings, the weight of the company, when it was bought. And as I mentioned, pay attention to the newer holding. And in this case, this was a new purchase relative to the other ones. It shows you the share change, whether it's going up, whether it's going down. And that might give you an indication of how the manager is feeling about that company at that time. So, a great way to find new ideas. Next, spin-offs and corporate breakups. Now, I know some managers who've used this approach and have built major billion-dollar strategies by finding breakups and spin-offs. This approach would basically involve looking for companies that are getting ready to spin off or have spun off subsidiaries. So you're going to generally want to view this as a catalyst for value creation. And the reason why they would spin off or break up their company is because the subsidiary usually is undervalued and not getting the attention or the value in the marketplace that it could deserve. So by splitting that company off, both stocks could be appropriately valued by the marketplace. So there could be some neat little business inside a bigger conglomerate. As it gets spun off, it gets more appropriately valued, and both stocks can appreciate from that. But also assess management's plan of the spinoff, whether they really have the tools and ability to make this into a viable business. There's some risk as a spinoff breaks away from a bigger company that they become undersized. They don't have the resources and tools necessary to be successful. So really you have to assess management's plan. Do they have viability? Do they have the ability to grow? But as that company gets spin off, you may have a real opportunity to grow, to be more appropriately valued, to be more focused, to be more incentivized, to have more skin in the game by management. So it can be a very good thing for both the spinoff and the parent. But watch for volatility. As that company gets spun off, you may actually see that stock go down momentarily because major holders or index funds may not be able to or may not want to own that spinoff because it doesn't fit their strategy or is too illiquid for it. In the case of an index, they may not be able to own it. But research the parent and the spinoff both because both could be beneficiaries of that. If you go to the website or my website, sunrisestockresearch.com, you'll find some case studies that involve spinoffs and why that spinoff was successful and what you can look for in the future to find and identify those future spinoffs. The big negative is that there's very few of these companies that actually get spun off. So they're more of one off, and you really have to dig in and do research. But on the other side is if you find a good, if you do your research, there's a lot of gems that could be found by this method. Next, IPOs and direct listings. Now, IPOs tend to generate a lot of attention, they get a lot of hype. They come out with pretty much a big bang and a lot of splash. So there tends to be a typical overvaluation that comes from a new stock offering. However, if you're interested in this, there is some approaches you can take. First, I'd recommend visiting the NASDAQ IPO calendar, as they'll tell you what is scheduled to come out, what potentially could come out not only in the next weeks or but possibly months down the line. So you can really get prepared to know what is coming out. They'll also tell you what has IPO'd recently, this past year, last year, the year before then. They have a whole calendar that can tell you what stocks have IPO'd. Next, if you find a stock that you're interested in, you can go to retailroadshow.com and you can watch the roadshow. And a lot of times those have great information. They're very informative and very interesting. They can tell you a lot about the industry and the company and what is going on that could be of interest to you. So some tips for approaching IPOs. First, you should understand that for a retail investor to get participation in the initial offering is going to be pretty rare. And that's because IPO allocations tend to be reserved for the investment bank's best clients. So they tend to reward their clients with good allocations, and that means for a retail investor, the ability to participate in that offering is going to be very limited. And if you do get shares offered to you, it very well may be that that's because that offering is not going well among the institutional investors. So be very wary of actually getting those shares offered to you unless you have some inside track. But focus on fundamentals. As I mentioned, these often get overhyped, but focus on really what's going on with the company and their ability to generate profits. Beware of overvaluation. So you may want to wait to buy that stock. Over the next quarters, 9 to 12 months later, a lot of the hype tends to get washed out, and that could be a better opportunity to buy into the offering. Alternatively, you could have that approach, go back to the IPO calendar at NASDAQ IPO calendar, and you could find out what IPO'd 9, 12, 18 months ago, and use that as a good starting point to approach IPOs. I'd also say evaluate what's going on within the sector, that if you find that the sector itself is doing well, that may be a very good indication that that stock could be in good shape. That rising tide lifts all boats, but if you find their peers are doing quite poorly, that may be a red flag for that company as well. Next, analyst upgrades. So analysts tend to upgrade stocks based on usually strong fundamentals. And they tend to have a lot more inside knowledge of a company, of an industry, than most ordinary investors. So following those upgrades could be a good treasure trove for finding new ideas. But context matters. Pay attention to credible analysts who actually upgrade based on strong fundamentals. Sometimes you'll find that analysts will upgrade a stock because they've been neutral on a stock for too long, so they basically just want to get back to not being so negative because that stock has gone against them. So really follow the credible analysts who tend to have been right on that stock more than they've been wrong. Um, but also, I'd say follow the top pick list. If an analyst follows 20 companies, you might find that they have 10 companies which they have buy rated, 8 or 9 companies that are neutral, and they may have 1 or 2 companies that they are sell rated on. Of those 10 buy rated companies, they may have one stock that they really like, and that top pick means a lot more than the other 9. So that top pick list are usually a better place to start. Next, options flow and unusual activity. Now, this is really looking for maybe short term oriented, but some real good activist and large institutional activity and information they may have and feelings they have going into an event. Some resources that I use that would identify big options trades would be Option Strat, Bar Chart, and Usual Whales. Those are some resources you can use to find activity within that space. Um, Advice one, look for very strong, unusual activity, high volume, large black trades, deep out of the money call buys. But also look for a catalyst. If you notice there's an upcoming earnings report, a regulatory event, or some economic data, that could be buying ahead of that catalyst. So some positive potential news flow coming out for that company. 3, compared to that sector-wide activity. That just gives you broader information about, is it a company-specific event or more of a sector-wide trade? But use those tools and alerts to set it up activities so that you can be aware of what is occurring and what potential news flow could be happening. Now, this next method is trend spotting. Trend spotting is looking for major trends and changes in the way the world works. So, the way that people live, how they work, how they shop and play, and trying to identify opportunities to be able to benefit from that trend. So, you're looking for shifts in consumer behavior, rising demand for new technologies, or changing regulations. A lot of people think of major trends because they're pretty easy to identify, and those trends can last many, many years, in fact, decades or more. But there are also smaller trends that can give good investment opportunities because they're less hyped. So once you identify a trend, validate the trend with the data. Assess the market adoption, the competition within that trend, and sustainability. But avoid overpaying for those stocks. So try to pick your point to be able to get in. The best investment plays really are the leaders. The plays in infrastructure, providing support for that, and sometimes the early stage innovators positioned for explosive growth. So when you think about the major trends over the last couple of decades, there have been some major winners in those areas. So in the PCs, Microsoft, with smartphones, Apple, with streaming, Netflix, with AI, we have NVIDIA. What would be the next big trend? Could it be quantum computing or robotics? I guess time will tell. And who the leaders in that space are going to be is going to be yet to be determined. So let's keep an eye on those trends and look for opportunities to buy into that trend. However, there are some smaller trends that take place all the time. We just have to be mindful and look out for them. So next we have ESG and sustainability. And this is becoming a major investment driver, especially as institutional money flow is flowing into ESG. We're seeing especially a lot of European investors, large institutions, pension plans, asset managers are pouring billions of dollars into ESG stocks. So many won't touch stocks that have poor ESG scores. And in fact, the regulators are kind of demanding that mutual funds disclose their ESG ratings and make sure that they actually are paying attention to ESG scores. We also have a lot of regulatory changes that have taken place that are pushing higher and higher regulations on companies. So those are positioned already to benefit from that, are in a better position than their peers. Also, we're seeing consumers are more oriented to favor ESG-oriented companies. So they like to see that the companies that they buy from have some kind of some acceptance of governance, of some social policies and environmental policies. So we're seeing more and more focus on companies that have some kind of ESG awareness. I would caution though not to go too far into companies that have that go too far into the political spectrum, as that can be a double-edged sword for them. So the way you can find ESG companies is there are some companies that have ratings. MSCI, S&P Global, and Morningstar all provide ratings for ESG. And you can monitor those ratings and screen for high or improving ESG scores. But also, because there's so much money flowing into those stocks, balance the valuation, which tends to be higher, with the fundamentals. Also, focus on materiality. And what I mean by that is there's some scarcity in companies that score high in certain sectors, such as utilities and energy, whereas there are many companies that score higher in other sectors like technology. So focus on what can be material for that sector. So hopefully that can lead to finding some ideas positioned for strong, positive future money flow. So next we have exploring supply chains. And this would involve really trying to look at the broader ecosystem behind some trends and companies that are doing well, or industries that are doing well, to try to find unique suppliers or ways to play that trend. So an example here would be, we know that NVIDIA is seeing strong demand for their chips. So therefore, we want to look at who are NVIDIA's suppliers, who is fabricating the chips for NVIDIA, and who is making the capital equipment to manufacture and fabricate those chips. That would be one example of that. So understanding throughout the supply chain, the inputs, the distributors, all throughout that chain of who the beneficiaries are, can help us get a leg up in trying to identify new ideas. So first, I'd recommend starting with the industry leaders. Those tend to be the biggest beneficiaries of the trend within the supply chain. But then focus on the essential players from there. And you would identify an essential player by someone who has a very strong niche. And you might see that they have a strong margin profile. And that tells me that it's more than just a commodity player within that supply chain, that they're providing something special and unique that would be difficult for their customers to replace. Also, monitor the sector trend. Understand the broader trend driving the growth. In the case of electric vehicles, that would benefit not just the automakers, but also, say, the charging stations or the semiconductor suppliers that go into the chips, or the battery manufacturers. So really try to understand the whole, how the industry works, and monitor that sector as a whole. Next would be a niche ETF. And this is really more of a theme investing as well. So you would approach this in kind of a similar way to cherry picking, although I would say the stocks that get put into an ETF are not quite nearly as well vetted as ones that go into mutual fund. So this is more of a theme investing. So it kind of ties into trend spotting, finding ideas from trends and ETFs that are kind of in favor. And I would say you're going to find leaders and innovators. So you might find the company that is the strongest player within that trend, but also a company that may be innovating and growing and potentially become a material player within that space. You might also look for some small niche players that are underappreciated, playing into that ETF. Also take different ETFs trying to do the same thing, and compare holdings across those ETFs to find new ideas. Also, I always like to find new ideas that are recent additions, because those tend to be fresh and maybe overlooked ideas from other investors. The next approach would be alternative data. And alternative data would be looking at things such as Google search trends, app downloads, satellite imagery, web scraping, and credit card transactions. These might give you some insight into trends and stocks that may have some interesting new things going for them. If you're going to use this approach, start with a clear goal in mind about what you want to accomplish and what kind of stocks you might be able to uncover with alternative data. But never rely on that data alone. Pair it with traditional data. Make sure that what you're doing makes sense. Focus on reliable sources and understand the industry context all in. So, for instance, if you go to the app download trends and you do notice that there's a certain app that tends to be getting more attention, such as Duolingo, for instance, that would be something that a stock that might show up as an interesting company because they tend to get a greater share of the app downloads, and a growing trend indicates there's some changes going on and behavioral changes that are taking place that could lead to positive stock momentum. Finally, conferences and expert opinions. Now, these are a great way to find new ideas, but unfortunately for most retail investors, conferences tend to be quite exclusive to institutional investors, so very difficult to get participation in these conferences. However, there are ways in which investors can benefit from these conferences that are taking place. First, focus on thematic conferences. So there are some conferences that are oriented toward healthcare or energy. And once you know these conferences are going on, you can pay attention to what is coming out of that conference. And you can access many of that information, the conference materials, online. So for instance, companies are publishing their presentations through their investor website. They're also presenting their transcripts. So you can analyze that. You can run it through a chat GTP to give you the output of those transcripts and try to get some insight into what is occurring at that company and within that theme at that conference. Third, you can follow the media coverage leading up to and post-conference to find interesting data points. And finally, you can monitor those stocks and how they're moving as that conference unfolds. So positive news flow, negative news flow, and what investors are doing coming out of the conference. So there are ways in which you can benefit that doesn't involve actually participating at that conference. If you do get the opportunity to go to a conference, I would highly recommend it, as they are a great way to be able to meet inside companies with inside an industry, to talk to the analyst and talk to other investors at those conferences. The important thing to keep in mind is that each of these approaches lead to ideas that are only starting points for further research. In future videos, I'll show you how we approach the stock research process. In the meantime, visit sunrisestockresearch.com for further information. There are great case studies that talk about my experiences over the past 2+ decades in researching companies and picking stocks, as well as market insights about what is timely in today's market. Until then, good luck investing and best wishes.